Keith, talk a little bit about the start of this year and what it's told you about the character of this market.
Yeah, well, great to be with you, Mike. It's interesting. We're talking about a broadening trade within the overall market, but then within tech, you're actually seeing more divergence. So, a lot of difference from last year overall. But I do think what we're seeing when we look at, industrials up 7%, small caps up 7% for the year, tech kind of flat. I think we have one, rotation. January tends to be a mean reversion month. And there's some, obviously optimism about this economic uptick. But we're also just seeing things that were being up, like staples, which in theory shouldn't really benefit that much from an economic uptick, also up. So it's really a broad-based rally, both in the U.S. and Mike, we follow over 40 countries globally, and all of those countries are above their 200-day moving average. So that just speaks to the breadth of this global bull market.
Yeah, there's no doubt it's a globally synchronous move at this point. But you mentioned the staples rally, which was very sharp, and nobody was positioned for it really. And I wonder if it was so sharp just because you have this wild churn in the market. You have these, quant players or whoever out there. It's just getting caught off sides repeatedly. I wonder how we can find any signal in that noise.
Yeah, well, one thing we looked at coming into this year, staples, I believe on a 3-year basis, has underperformed by more than 60% relative to the S&P. That's one of the most dramatic underperformance we've seen in history. So all you need when the rubber band that stretch is a little bit of good news. I'd also say, hey, Mike, the top holding in the staples sector is Walmart. And they actually benefited from some of the AI trade, too, in some ways.
Yes, Walmart and Costco's in there as well. So you guys are still overweight tech and communication services. Does that mean that you expect kind of the former leadership to remain intact or reassert itself?
Yeah, those are legacy positions. We're still staying there. We did add industrials. We upgraded energy materials as well back in December. But I will say, Mike, I'm actually happy to see some of the optimism come out of tech because the earnings momentum for tech is still positive. So to your point, we still are positive on tech long term. I don't know how quickly it reasserts itself, but I think it's hard to be negative on tech. I think in the interim, we still like having a position in both. And I think in the near term, the broadening theme probably has a bit more to go.
Yeah, there's no doubt that. I mean, it's remarkable that 4 months ago, the whole talk was AI bubble, and then that whole trade is kind of deflated to date. What about the general state of investor sentiment? I was talking a little bit about things looking a little bit heady.
Yeah, I would agree with that. We have one index that looks at newsletter writers, and that's showing the most equity allocation we've seen in some time. I think, so sentiment, I would say, on the margin is somewhat optimistic, but not euphoric. The one thing I'd pay attention to, maybe a risk, is that 10-year Treasury is now pressing against 425. We start seeing that move. That's not penciled into most people's forecasts. So that's what I would be watching more than anything as a risk to this market right now.